If you observe carefully what is happening in financial markets right now, you will notice something that most people are not talking about. The stock market has been rising. Headlines celebrate the gains. Retirement accounts look healthier on paper. And yet, underneath this surface calm, something fundamental is breaking. The rally you are watching is not a sign of economic strength. It is not a signal that the worst is behind us. It is the final exhale before a system that has been stretched far beyond its natural limits reaches the point of no return. The stakes here are not abstract. For the tens of millions of Americans between the ages of 40 and 80 who have spent decades building savings and contributing to 401k plans, the question of whether this rally is real or illusory may be the most consequential financial question of your lifetime. This isn't a prediction. It's a logical consequence. When a system accumulates enough internal pressure, whether that system is a dam, a bridge, or a financial market, the eventual result is not a matter of opinion. It is a matter of physics. I have spent more than 40 years studying debt cycles, monetary systems, and the mechanics of how wealth is created and destroyed across generations. I have watched governments make the same promises and the same mistakes. I have seen the same patterns repeat with a consistency that should humble every investor who believes this time is different. When you understand incentives, you understand behavior. And right now, the incentives driving this market rally are not aligned with your long-term financial health. The United States currently carries more than $34 trillion in national debt. Annual interest payments on that debt have now exceeded $1 trillion, more than the entire defense budget. At the same time, the Federal Reserve spent years injecting trillions of dollars into the financial system through quantitative easing, effectively printing money and flooding markets with liquidity. That liquidity had to go somewhere. It went into stocks. It went into real estate. It went into assets. And now, as that liquidity begins to drain from the system, as interest rates remain elevated and credit conditions tighten, the prices that were inflated by that artificial stimulus are being held up not by genuine economic growth, but by momentum and by the hope that someone else will keep buying. Think of it like a seesaw. On one side, you have asset prices, stocks, bonds, real estate. On the other side, you have the real economy, wages, productivity, sustainable corporate earnings. For a long time, the financial side of the seesaw was lifted artificially. The Federal Reserve put its hand under that side and held it up. But a hand can only hold weight for so long. When it lets go, and it always eventually lets go, the seesaw snaps back. The question is not whether it will snap back. The question is how hard the landing will be, and whether you are positioned correctly when it does. History is an excellent teacher. The problem is that most people only read the parts of history that make them comfortable. In August of 1971, President Nixon severed the connection between the US dollar and gold. At the time, the markets initially rallied. It felt like freedom. What followed over the next decade was one of the most painful periods in American financial history. Inflation surged to double digits. The stock market, adjusted for inflation, lost roughly half of its value across the 1970s. The apparent liberation of 1971 became the slow-motion crisis of the following decade. In 2000, the Nasdaq reached its peak. Technology stocks were priced as though the laws of corporate valuation had been permanently suspended. The argument at the time was that this was a new era, that old metrics no longer applied. The market then fell roughly 78% from its peak. Retirement accounts built over decades were cut in half or more within months. Many people never fully recovered. Then in 2007, the housing market was booming. Mortgage securities were being sold with AAA ratings, and the mainstream financial press was largely telling people that housing prices only go up. By 2008, Americans lost an estimated $13 trillion in household wealth in 18 months. Each of these moments had a common feature. In each case, there was a rally, a period of apparent strength that encouraged people to stay in, to increase their exposure, to believe that the warnings were overblown. In each case, that final rally before the fall was interpreted as proof that the pessimists were wrong. The people on the inside, the institutions, the large players, began to quietly exit. The resulting momentum provided the liquidity those insiders needed to get out at favorable prices. The retail investor, reading the headlines and seeing the gains, stayed until the door closed. To understand what is happening today, you need to understand three fundamental principles. The first is that debt cycles always complete. There is no historical example of a society that accumulated extraordinary debt and simply grew its way out without some form of financial pain. The tools governments use to manage this, inflation, currency devaluation, financial repression, all transfer wealth from savers to debtors, from ordinary Americans with retirement accounts to the government and to the financial system. The incentive of a heavily indebted government is to allow inflation, because inflation erodes the real value of what it owes. If you are holding cash, bonds, or fixed income instruments, inflation is your enemy right now. The second principle is that financial asset prices and real economic value must eventually converge. They can diverge for extended periods, sometimes years, sometimes longer, but they cannot diverge forever. Today, the price-to-earnings ratio of the S&P 500 sits at levels that historically have preceded disappointing returns for the following decade. Corporate profit margins, which expanded dramatically during the era of cheap money and globalization, are now under pressure from higher input costs and rising labor expenses. When stock prices are high relative to earnings, and earnings themselves are under pressure, the arithmetic of future returns becomes deeply unfavorable. This is not sentiment, it is math. The third principle is that monetary policy operates with long and variable lags. The Federal Reserve raised interest rates from near zero to above 5% in one of the fastest tightening cycles in its history. The full effect of those increases has not yet been felt throughout the economy. Commercial real estate is already showing significant stress. Regional banks are carrying unrealized losses on their bond portfolios. Corporate debt issued at low rates must be refinanced at dramatically higher rates over the coming years. These are slow-moving processes. They do not show up immediately in stock prices, but they accumulate, and when they surface, the adjustment can be sudden and severe. Let me tell you a story about two people who faced a moment very similar to the one we are in now. We will call them Robert and Margaret. Both had spent their careers in the Midwest. Both had saved diligently, and both found themselves in 2006 with approximately $650,000 in their retirement accounts, nearly all of it in U.S. stocks and bonds. Robert's financial advisor told him to stay the course. The market was up, the economy seemed strong, and people felt wealthy. Robert stayed fully invested. Margaret had grown concerned about the level of debt in the housing system. Her advisor pushed back, told her she was being too cautious. She moved 40% of her portfolio into inflation-protected securities, gold, and international assets in early 2007. By March of 2009, Robert's $650,000 had become approximately $295,000. He was 61 years old and had lost more than half of what he had built. He delayed retirement by 6 years, working until 67 in a job he no longer wanted, watching every market movement with anxiety. He never fully recovered what he lost. Margaret's portfolio declined as well. No portfolio was immune in 2008, but her $650,000 had become approximately $490,000 at the trough. Within 3 years, she had fully recovered. She retired at 63 as she had planned. She left her children a meaningful inheritance. This isn't made up, it's the typical pattern. The difference between Robert and Margaret was not intelligence. It was the willingness to take seriously information that was uncomfortable and to act before the moment of crisis rather than after it. Now let's translate this to what really matters, how this affects you. If you are 60 years old with $500,000 in a traditional portfolio weighted toward U.S. equities, you are carrying more risk than the headlines suggest. A 30% decline, which is not an extreme scenario, it happened in 2022 and was far worse in 2008, would reduce that portfolio to $350,000. That is not just a number. That is the difference between retiring when you planned and working 3 to 5 more years. Consider the mathematics of loss. If your portfolio falls 40%, you need a 67% gain just to get back to where you started. That asymmetry is what makes capital preservation the most important discipline for someone within 15 years of needing to draw on their savings. The purchasing power dimension of this risk is often overlooked. If you are living on $5,000 a month in retirement today, and inflation runs at 5% annually for 5 years, your effective purchasing power will have declined by approximately 22%. The groceries, the utility bills, the medical expenses consuming an ever-increasing share of retirement budgets. These are not abstract. They are the daily reality for millions of Americans who saved responsibly and are now watching the value of that savings erode in ways that no account statement ever fully captures. Based on these principles, here are practical guidelines for protecting what you have built. Doing nothing is itself a decision. Staying fully invested in a market trading at historically high valuations is not a neutral choice. It is an active bet that conditions will remain favorable. Consider moving toward a more defensive allocation. A reasonable structure for someone between 55 and 70 might look like this: 35% in Treasury inflation-protected securities, 20% in physical gold or gold-backed instruments, 20% in broadly diversified international equities, 15% in cash or cash equivalents, and 10% in U.S. equities concentrated in companies with strong cash flows, low debt, and genuine pricing power. Implement any changes gradually over 6 to 9 months. Set a rebalancing schedule and commit to following it regardless of what the market is doing. Prepare yourself psychologically for the discomfort of this process. The market may continue to rise after you reduce your equity exposure. You may feel temporarily that you made a mistake. This is the moment where most people reverse course, just in time for the decline that their original instinct had correctly anticipated. The purpose of a defensive allocation is not to maximize returns in a bull market. It is to ensure your financial survival when the bull market ends. Nothing in this analysis constitutes specific financial advice for your individual circumstances. Each person's situation is different. Different time horizons, different income needs, different tax situations, different risk tolerances. Before making any changes to your portfolio, consult with a qualified financial professional who has a fiduciary obligation to act in your interest. The choice is yours. But before you make it, consider what is actually happening beneath the surface of this rally. Central banks around the world have been quietly increasing their allocations to gold and reducing their holdings of U.S. dollar-denominated assets. The countries that hold the largest reserves of U.S. Treasury bonds have been net sellers for several consecutive years. When the largest creditors of the most indebted nation in history start to quietly reduce their exposure, that is a signal worth taking seriously. The rally continues for now because momentum and institutional incentives sustain it. But the structural conditions that supported decades of consistent equity returns, low interest rates, expanding globalization, a reserve currency with unquestioned dominance, are all under pressure simultaneously. That's why this channel exists. Not to generate fear, not to predict specific dates with false precision, but to observe signals before they become obvious to everyone, because by the time they are obvious, the opportunity to act has passed. If this analysis makes sense to you, subscribe to this channel. Share it with someone whose retirement is at stake. The most important protection we can offer the people we love is not a specific stock tip. It is the framework to see clearly when the incentives of the system are pulling them in the wrong direction. History does not repeat exactly, but it rhymes with a consistency that should make every thoughtful investor pause. The last exit before collapse is rarely marked with warning signs. It looks, from the outside, like just another day in a functioning market. The difference between those who protect what they have built and those who do not is not luck. It is the willingness to look at what is actually happening, take it seriously, and act before the crowd reaches the same conclusion. By then, the exit will be closed.